This is Dinar Shift, and we begin with news that is shaking the very foundations of the global currency exchange community. After years, in fact, for some decades of patient observation, relentless speculation, and the constant flow of hopeful, sometimes frustrating rumors, a seismic shift has now been confirmed across international financial networks. We're talking about the formal activation of new reference rates, a move initiated by the Central Bank of Iraq, CBI, that doesn't just pertain to the Iraqi Dinar IQD, but strikingly appears to be mirrored by a simultaneous adjustment involving the Vietnamese Dong VND. This is not a fleeting internet whisper or a speculative blip confined to fringe markets. This is an institutional reality, a structural change that is rapidly embedding itself within the core mechanisms of global banking and settlement. The gravity of this moment can't be overstated. It signifies a conscious decision by both nations to recalibrate their currencies' standings, forcing major international players to adjust their operational frameworks immediately. The narrative that once existed only in the realm of theory is now being enacted through formalized banking protocols, marking a monumental pivot in the world of emerging market finance. The epicenter of this dramatic financial re-engineering lies within the hallowed halls of Baghdad, specifically the Central Bank of Iraq, the nation's highest monetary authority. This action was not a sudden impulse. Sources indicate it was the result of incredibly meticulous planning and intensive technical groundwork executed over a considerable period. Well in advance of any public disclosure, the CBI undertook the intricate, behind-the-scenes task of completely recalibrating its entire exchange rate machinery, ensuring perfect synchronization across both domestic and international platforms. This involved more than merely keying new numbers into a database. It required running rigorous compatibility tests on cross-border payment systems, aligning the fresh rate data with SMEFT messaging protocols, the communication backbone of global finance, and fully integrating internal compliance processes with updated international banking regulations. Furthermore, the necessary foreign reserves and currency swap facilities were prepared and positioned to absorb the anticipated surge in upgraded financial flows, suggesting an extraordinary level of foresight. This level of preparation confirms the move was not hastily conceived, but was, in fact, a meticulously orchestrated project spanning multiple critical departments within the Iraqi government and central bank. From the teams focused on shaping monetary policy to those managing overseas liaison offices and correspondent banking relationships, every element was coordinated to ensure the new rates would be adopted and processed without friction across the complex, layered chains of international banking. Iraq appears to be intentionally projecting an image of stability and sophistication to the world, presenting a newly calibrated exchange mechanism designed specifically to solidify the dinar's position. This strategic maneuver is intended to make the IQD a more predictable, reliable fixture in the global systems of trade, capital investment, and foreign exchange, lending undeniable practical weight to a move that is also profoundly symbolic. It is a powerful statement about renewed financial confidence and institutional credibility. What makes this financial juncture doubly remarkable is the simultaneous, parallel action being observed in Vietnam. Banking data emerging from Hanoi and Ho Chi Minh City suggests that Vietnamese authorities are likewise activating significant currency adjustments at this precise time. The Vietnamese Dong VND, historically maintained at a tightly managed, relatively stable rate against global currencies, is now exhibiting signs of newly emerging trading values and reference rates that are dynamically shifting. These signals, while initially cautious, point to a clear transition by the Vietnamese central bank away from a rigidly fixed or externally managed currency posture. Instead, they appear to be embracing a model more acutely responsive to prevailing global market pressures and the inherent dynamics of international capital flows, demonstrating increased confidence in their economic resilience. Vietnam's economy is an undeniably potent force, continually bolstered by robust export manufacturing, sustained trade surpluses, and a rising influx of foreign direct investment, all of which position it as a textbook candidate for such a strategic monetary shift. The coordinated adjustment of the dong alongside the dinar offers compelling evidence that both nations may be signaling a shared, broader ambition to assert greater financial sovereignty on the world stage. By consciously reducing their dependence on external or pegging mechanisms, Iraq and Vietnam are working to enable their currencies to participate more aggressively in global trade settlement and compete effectively in international markets. This striking synchronicity hints at a deeper level of awareness, perhaps even consultation between the central banks moving in parallel to take back the agency over the determination of their own national currency values. Perhaps the most compelling, attention-demanding validation of this evolving situation comes from within the United States, specifically from Chase Bank, one of the nation's preeminent financial institutions. A carefully worded but profoundly impactful statement from Chase has rippled through foreign exchange trading circles, confirming that its internal systems are being actively prepared for new international exchange operations directly tied to both the Iraqi Dinar and the Vietnamese Dong. The message carries a powerful subtext. Specialized foreign exchange trading desks are being configured, internal compliance and settlement frameworks are being urgently updated to handle a potential flood of new rate flows, and sophisticated risk management protocols are being adapted to cope with the possibility of heightened volatility or significant liquidity shifts. For professional financial practitioners, the fact that a major Tier 1 U.S. bank has publicly indicated its operational readiness serves as an exceptionally strong validation. If a market heavyweight like Chase believes it must strategically position itself for an anticipated volume of incoming currency activity, it radically increases the probability of real, large-scale financial flows, confirmed transactions, and fundamental rate adjustments for holders of these currencies. This confirmation from Chase transcends mere symbolism. It represents one of the very first institutional acknowledgments that the long-standing revaluation narrative is successfully navigating its way out of the nebulous space of rumor and theory and firmly stepping into the actionable territory of institutional execution. The moment the global plumbing of finance begins to change, the entire picture shifts. For years, the concept of a revaluation of the Iraqi dinar existed primarily in a speculative, often wishful thinking realm, perpetuated through forums and anecdotal, unverified leaks. Yet, the current confluence of institutional moves, the CBI's official rate activation in Baghdad, the distinct emerging signals from Hanoi, and now the public operational posture adopted by Chase Bank, signals the story's transition into a tangible new phase. This is a progression toward concrete institutional infrastructure and the undeniable potential for consequential market action. While significant questions undeniably linger, including the speed of the transition rollout, the methods for liquidity support, and the pace at which foreign banks will formally adopt the new rates, the fundamental fact remains. The CBI has flipped the switch, and major global banking systems are visibly aligning themselves in response. This alignment suggests we are witnessing not simply transient market chatter, but the distinct possibility of structural, systemic change. Should these developments prove durable and sustained, the ripple effects are predicted to extend far beyond the immediate currency markets. They could profoundly impact major international trade contracts, influence the direction of foreign direct investment, improve the perception of sovereign creditworthiness, and fundamentally redefine the global perception of both the Iraqi and Vietnamese economies. For those who have devoted themselves to watching this unfolding story, the often arduous journey from an improbable rumor to an institutional reality is clearly underway, transforming what once seemed a far-off dream into the approaching contours of a verifiable truth. To grasp the full weight of this pivotal moment, it is essential to trace the history of structural effort, constraints, and the incremental, often challenging, rebuilding process that has characterized Iraq's financial system for over a decade. A key factor contributing to this current feasibility is the concept of monetary stabilization. Iraq has diligently worked over the past 10 years to steadily increase its foreign currency reserves, effectively curb uncontrolled fiscal overspending, and push for demonstrably greater transparency in both government accounting and reporting practices. This process has involved the Central Bank of Iraq, CBI, systematically fortifying its balance sheet, implementing tighter liquidity management protocols, and aligning many of its functional operations more closely with international financial norms. Despite the persistent pressures from volatile oil revenues and the inherent political instability within the region. In parallel with the CBI's efforts, the Iraqi government has persistently, though sometimes with pauses, attempted to mitigate large budget deficits, control persistent inflation pressures, and reduce the heavy reliance on off-budget expenditures that often bypassed standard oversight. These foundational efforts, though not executed flawlessly, have provided the essential undercurrent that makes an upward valuation of the dinar even remotely conceivable today. Without achieving at least a semblance of stability, whether it be genuinely real or simply perceived by external markets, a sharp adjustment in the dinar's value could easily become counterproductive, potentially undermining fragile international confidence rather than successfully restoring it. This groundwork has established the necessary platform for the current bold move. Beyond basic macroeconomic prudence, Iraq has also invested substantially in a sweeping digital banking overhaul. In recent years, the CBI and its affiliated governmental ministries have been tirelessly working to upgrade the nation's core payment rails, central clearing systems, and essential financial messaging infrastructure. The goal of this modernization is explicit: to align flawlessly with the rigorous expectations and technical protocols mandated by powerful international bodies such as the International Monetary Fund, IMF, the World Bank, and the Bank for International Settlements, ICE. Policy discussions in banking reform forums frequently reference the urgent need to establish or significantly bolster real-time gross settlement (CRTGS) systems to enhance sub-EFT network connectivity and to ensure that any prospective new exchange regime is capable of deep, instantaneous integration into global banking networks. These digital upgrades are profoundly critical to the integrity of the current announcement. Simply changing a figure on a rate sheet is a trivial exercise. The real work, the heavy lifting that consumes time and resources, is modifying the underlying plumbing so that every corresponding bank, every correspondent network, and every external financial system instantaneously recognizes and accepts the change securely and reliably. From this perspective, the current event is less a simple, isolated repricing and much more a full-scale systems launch, the act of synchronously, securely, and robustly activating new digital rails that connect local finance directly to the international ecosystem. This systematic approach speaks volumes about the commitment to long-term change. Another crucial piece of this complex financial puzzle involves Iraq's sustained efforts to decisively clamp down on the parallel or black market currency activities. For many years, both in Iraq and across numerous other emerging economies, a large, unregulated exchange sector has operated through informal markets, existing partially or entirely outside of official regulatory oversight, often trading currencies at rates significantly divergent from the official figures. Such markets inevitably weaken the credibility of the central bank's declared rate, introduce economic distortions, and ultimately corrode public and international confidence in the formal system. Many influential, reform-minded economists and officials in Iraq have consistently argued that severely curtailing the liquidity within this parallel market is an absolute prerequisite for a successful revaluation. The logic is compelling. If the vast majority of dinar trading activity is channeled exclusively through regulated, official venues, the central bank's rate instantaneously gains far greater traction and meaning, moving beyond mere symbolism to becoming the authoritative price. This requires the implementation of much stricter oversight, including the rigorous licensing of all legitimate exchange houses, tighter enforcement mechanisms to prevent speculative arbitrage, and improved coordination with law enforcement agencies to effectively block illicit foreign exchange flows. As the transaction volume within that parallel market inevitably shrinks, the rate established by the central bank automatically accrues greater legitimacy and real-world traction. Therefore, the new rate we are now observing is more than a simple numerical adjustment. It is a powerful restoration gesture. This move is Iraq's calculated way of reasserting its full aspirations as a sovereign, responsible actor within the global financial order. It is a declaration to the world we possess the capability to establish, manage, and staunchly defend our currency with an appropriate level of transparency, discipline, and commitment to global integration. The parallel trajectory in Vietnam, while characterized by a more gradual approach, is no less strategically significant. For decades, Vietnam has meticulously constructed an economic model centered on aggressive export growth, deep integration into global supply chains, and the maintenance of consistently favorable trade balances. Its robust industrial sector, particularly in electronics manufacturing, and its solid global supply chain linkages, has steadily and significantly strengthened its foreign exchange buffers and financial credibility. As Vietnam's trade surpluses consistently accumulate, as foreign direct investment steadily pours in, and as the nation's macroeconomic fundamentals demonstrably stabilize, the Vietnamese government naturally gains increased flexibility and confidence to contemplate and execute major currency adjustments. Over an extended period, Vietnam has incrementally loosened various capital account restrictions, proactively allowing the dong to adjust more responsively to market conditions and aligning an increasing number of its trade contracts with prevailing international market rates. Consequently, when we now discuss a major dong adjustment, it is less an abrupt, market-shocking event and more an official recognition that Vietnam, through years of consistent economic achievement, has earned the necessary credibility to assert a stronger, more representative valuation for its currency. In essence, the global market is no longer viewing Vietnam as a merely peripheral economic actor. The current shift in its currency's value is a direct and necessary reflection of the international acknowledgement of its rapidly rising economic weight and importance. The combined dual movement, Iraq and Vietnam both making significant currency shifts at the same time, powerfully augments the broader narrative. It strongly suggests that we may be witnessing a pivotal moment of coordinated currency evolution that extends across multiple emerging markets, establishing a precedent for others to follow. This synchronized action carries far greater significance than two isolated national policy decisions. The question of why Chase matters boils down to the mechanics of international finance. Large-scale currency revaluations demand far more than just internal policy decisions from domestic central banks. They require genuine institutional cooperation and, critically, legitimacy bestowed by major global banks, particularly those in the United States and Europe, which function as indispensable hubs for international settlement and liquidity provision. When a major player like Chase issues a public declaration that it is systematically preparing its complex systems to handle new dinar and dong flows, this is a tangible, operational signal, not simply a public relations exercise. It signifies that one of the most consequential entities in global banking is actively positioning itself to absorb the incoming change, which immediately transforms the adjustment from an isolated local reform into an integrated part of the global financial plumbing. From a technical standpoint, this process is intricate and ongoing, far from the simplicity of flipping a single switch at midnight. It demands secure, deep coding changes, the bridging of vast data flows between existing currency pairs, the complete updating of complex algorithms that are responsible for pricing and quoting rates across platforms, and the crucial work of ensuring anti-money laundering's AML checks remain robust and fully compliant. It involves embedding the new rates deep into the core of trading platforms and settlement systems. Once this sophisticated infrastructure is fully activated and running, the opportunity for denial or resistance significantly diminishes. The new rates become irrevocably embedded, not merely a superficial layer. As major, globally recognized banks like Chase go live with these new operational frameworks, a powerful domino effect is typically triggered. Smaller commercial banks, regional credit unions, and various regional financial institutions often maintain a cautious stance, waiting until the unquestionable Tier 1 names take the lead. But once institutions like Chase, Citi, or HSBC begin reliably pricing and clearing transactions using the newly activated dinar and dong rates, their peers are compelled to follow suit rapidly. Reports are already circulating, albeit anecdotally, suggesting that some banks in both the US and Europe are making back-end technological updates that mirror the new incoming signals for IQD and VND, even if external, customer-facing announcements have not yet been made. This illustrates that the new plumbing is being laid well before the final signage is posted. Returning to Baghdad, the Central Bank of Iraq's deliberate planning is the key to understanding the execution. Internal sources confirm that technical preparations were exhaustive. This included meticulous recalibration of the entire exchange rate machinery across domestic and international interfaces. Crucially, this involved extensive compatibility testing on all cross-border payment systems and the strict alignment of the new rate data with the secure STU-FT messaging protocols, ensuring that foreign reserves and any necessary currency swap facilities were immediately ready to accommodate any sudden influx of upgraded financial flows. This meticulous orchestration, involving departments from monetary policy to overseas liaison, underscores the non-spontaneous nature of the decision. In essence, Iraq has consciously and deliberately prepared to present the world with a fundamentally newly calibrated exchange mechanism, one designed to place the dinar on a significantly firmer foundation for global trade and capital flows. The action originating from Baghdad carries immense symbolic weight, signaling a pivot point for restored confidence, legitimacy, and institutional credibility on the world stage. Similarly, the simultaneous shift in Vietnam, driven by its powerful export-led economy and bolstered by strong trade surpluses and foreign direct investment, is a recognition of its established economic strength. By adjusting the Dong in tandem, both nations are demonstrating a unified ambition to assert greater financial autonomy and allow their currencies to compete and settle more effectively in the international marketplace, suggesting that central banks are indeed moving in a parallel, coordinated effort. The most important headline-grabbing signal remains the public posture of Chase Bank, which has acknowledged its internal systems are being configured for the new international exchange operations related to both the dinar and the dong. This institutional readiness, the configuring of specialized foreign exchange desks, and the updating of internal compliance and settlement frameworks to handle new rate flows are all powerful indicators. For professionals, Chase's acknowledgement is a validation that the probability of real flows, actual transactions, and official rate adjustments is far greater than before. The movement is now firmly in the territory of institutional execution, transitioning from years of theory to the activation of tangible financial infrastructure. The path forward, from the initial rumors to the current reality, remains one of cautious optimism tempered by the complexity of global finance. While the confluence of institutional actions, from the CBI's activation to Hanoi's emerging signals and Chase's public positioning, pushes the narrative into a new phase of market action, many critical questions persist. The pace of the transition, the level of support for liquidity, the swiftness of foreign bank adoption, and the pathways for currency conversion across correspondent networks are all ongoing variables. Yet, the undeniable fact is that a structural change has been initiated by the CBI and is being actively accommodated by major global banking systems. If these structural developments prove sustainable, the ripple effects are expected to reach deep into international trade, foreign investment patterns, and sovereign credit ratings. Furthermore, the strategic timing of this activation is almost certainly not a coincidence. Reports suggest that in Iraq, major trade agreements in sectors like energy, infrastructure, and technology may have already been struck using new financial frameworks tied to the revalued dinar. If confirmed, this indicates the government may have been internally utilizing and testing the updated rate quietly for some time, settling contracts and calibrating the real-world impact before making any public announcement. Vietnam, likewise, has been actively securing key export and technology partnerships, steadily increasing its foreign exchange reserves, and bolstering its international bargaining position. In both cases, the realignment of currency rates appears to have been meticulously prepped behind the scenes to coincide with these major external economic milestones. Ultimately, the success of this monumental change is fundamentally dependent on synchronized digital banking infrastructure. Both nations must either possess or successfully upgrade to robust real-time gross settlement (RTGS) systems, which are essential for enabling immediate, secure international payments. Once these advanced systems are fully operational, rate changes can cascade through global networks both quickly and reliably, significantly reducing volatility and settlement risk. Therefore, the switch being flipped today is not merely a price adjustment, it represents the activation of the entire digital infrastructure that securely connects local Iraqi and Vietnamese banks directly to the global financial ecosystem. following the Central Bank of Iraq's formal rate activation and the clear parallel movement of the Vietnamese Dong, currency markets worldwide are demonstrably beginning to stir. Traders, speculators, and institutional desks alike are reporting a sharp, undeniable uptick in focused interest directed toward both the Iraqi Dinar and the Vietnamese Dong. In private financial chat rooms and on social media, market participants are actively posting about the tracking of order flow, the opening of pending positions, and verifiable signs that liquidity providers are quietly repositioning their assets and their trading posture. While publicly accessible Forex platforms may not yet fully display the newly adjusted rates, a situation insiders suggest is part of a deliberate, staged, and controlled rollout, the back-end engines and settlement systems are unequivocally in the process of calibrating. This calibration process, executed behind a necessary veil of gradual review, is actively clearing the technical pathways for the massive shift. Concurrently, in the United States, a distinct set of developments is emerging for individual currency holders. Private holders of these currencies, ranging from those with modest portfolios to others with more substantial holdings, report receiving various communications from their exchange houses or brokerage desks. These notices include procedural requests for supplementary verification documents, notifications of scheduled appointments, or specific preliminary steps required to upgrade account status in anticipation of handling the newly activated rate flows. Many view these notices as a direct downstream effect of Chase's earlier public infrastructure announcement. By signaling its preparation of compliance capacity and internal infrastructure, Chase may have effectively precipitated a procedural cascade for smaller, individual holders and exchange entities. It is highly probable that the official public exchanges will proceed in planned phases, with priority access initially given to high-volume institutional players. Retail or individual clients are expected to enter the process in later waves, only once the new systems have been thoroughly tested, and full regulatory clearances have been formally secured. A revaluation of this magnitude cannot simply proceed on promise alone. It requires a deep, functioning web of regulatory scrutiny, legal compliance, and international oversight. Agencies across the globe, especially organizations like the U.S. Treasury Department, the Office of Foreign Assets Control (OFAC), and various financial intelligence units, are undoubtedly watching this entire process with intense scrutiny. For a new currency regime to function reliably on a global scale, it must strictly satisfy all anti-money laundering's AML standards, ensure that Know Your Customer (KYC) rules are consistently enforced, and maintain sufficient, transparent audit trails at every node of the transaction. Before full public exchange activity can commence, the systems responsible for conversion, remittance, and settlement must successfully pass rigorous internal and external audits, including crucial cybersecurity stress testing and compliance validation. Domestically, both Iraq and Vietnam face their own internal regulatory checkpoints. Their respective central banks will need to closely and constantly monitor capital flows, actively check for any signs of speculative abuse, diligently manage volatility, and coordinate seamlessly with domestic financial regulators. This is to ensure that commercial banks, exchange houses, and all payment providers operate entirely within the newly aligned regulatory frameworks. Any significant lapses or anomalies, such as sharp, sudden spikes in demand, the emergence of exchange arbitrage schemes, or compliance breaches, could immediately force the central banks to intervene, potentially imposing caps or causing delays in the broader public rollout. Because revaluations are inherently sensitive, stability remains the paramount watchword, requiring the entire regulatory apparatus not only to police but also to smoothly guide the transition. At its core, the events unfolding are far more than a simple shift in a currency's market value. They represent a powerful reassertion of national sovereignty on the crucial financial turf. For Iraq, this moment is nothing short of historic, emerging from decades of conflict, sanctions, crushing inflation, political turbulence, and intermittent global disinvestment. The transition to a revalued dinar signifies the nation's readiness for deep re-entry into the sophisticated layers of the global financial system. It is a clear statement that Iraq can manage, defend, and integrate its currency in a rule-based, transparent manner, a move designed to actively invite foreign capital, infrastructure investment, and trade financing opportunities that may have previously remained dormant or skeptical. The international financial community, multilateral lenders, sovereign wealth funds, and private capital firms may all interpret this action as a signal that Iraq is definitively resetting its posture, proactively cleaning up past financial opacity, and earnestly seeking long-term credibility. Vietnam's trajectory, by contrast, elegantly dovetails with this narrative. Its economy has long outperformed expectations in manufacturing, exports, and global trade interconnection. By consciously strengthening the dong, Vietnam signals that it is not merely relying on the temporary leverage of a cheap currency, but is instead aiming for enduring stability, stronger domestic purchasing power, and earning greater respect in the crucial pricing of global supply chains. A more robust dong helps exporters manage exchange risk, yields more predictable capital flows, and significantly bolsters Vietnam's standing among its emerging market peers. Together, the synchronized currency activations from Iraq and Vietnam may ultimately be interpreted not as two isolated events, but as a broader, collective moment of revaluation leadership occurring across the frontier and emerging markets landscape. Even though official, public displays of the new, recalibrated rates may still be limited today, reliable reports strongly indicate that internal banking systems are already live with the adjusted values. Public availability is anticipated to follow a phased, controlled rollout, not an abrupt shock, but a gradual process specifically designed to maintain crucial stability, allow for ongoing technical calibration, and guard against disruptive speculation. The Central Bank of Iraq, in particular, is expected to move with extreme caution, rigorously monitoring liquidity conditions and exchange house behavior, and remaining poised to intervene immediately if necessary. Meanwhile, sophisticated banking systems across the Middle East and Asia are actively beginning to adopt and fully integrate the new signal infrastructure. Trading desks across Europe and other major forex hubs are reportedly on high alert, actively preparing to adjust their quoting engines, liquidity provisioning, and hedging desks in response to what may well become an expanding wave of similar currency revaluations across emerging markets. For anyone holding or intensely watching these currencies, this moment is far more than a simple milestone. It is potentially a historic turning point. Years of anticipation, frustrating delays, unverified leaks, and intense speculation may finally be yielding to genuine, verifiable institutional action. If all the complex elements align, regulatory vetting, banking cooperation, global liquidity, and stability mechanisms, this may indeed be the beginning of a much larger, global redefinition of how emerging economies assert their monetary sovereignty. We urge you to stay vigilant, as the next updates in this story will be critical.